Ever wondered what makes an LLP different from all the other forms of partnership businesses? What benefits does it offer compared to a traditional partnership structure like partnership firm? Hi, I am Tushar Bakshi, a startup advisor at Setindiabiz, where we provide tax, IPR and compliance services to businesses in India. In this video, I will be highlighting all the distinguishing features of a limited liability partnership that has consistently made it popular among investors, creditors, and customers alike. So let us begin without any delay. Parameters of differentiation. Number 1. Need for incorporation. Number of owners. Internal management and decision making. Liability of the partners. Audit. Compliances. Number 1. Need for incorporation. An LLP is a newer concept compared to a partnership firm. It was introduced in India in the year 2008 as an incorporated form of partnership business. So obviously it is legally mandatory to get it registered with the concerned authority. Compare this to a partnership firm which is governed by the archaic Partnership Act of 1932. The Act does not mandate registration for the firm but makes it optional, so that registering it absolutely depends on the will of its owners. But how does the requirement of incorporating a business concern you? Well, in this context, you must know that an unregistered business has a lot of disadvantages. For instance, an unregistered partnership firm cannot claim more than Rs 100 in the event of debt recovery, or cannot sue third parties in the event of a conflict. But registered entities like an LLP would never face such issues. Moreover, the process of registering an LLP is extremely quick, easy and 100% online. This not only saves the time and effort that goes into registration, but also drastically reduces its overall cost, with no miscellaneous paperwork requirements or travel expenses. In contrast, the process of registering a partnership firm is completely offline, which makes it quite exhaustive and time-consuming. Number 2. Number of owners. The second parameter that distinguishes a partnership firm from an LLP is the number of partners that both the businesses structures can have. The firm and the LLP are co-owned by multiple partners who share the investment and profits of the business. Since a partnership cannot be established with a single owner, both these structures require at least 2 partners to get established. The difference, however, is in their maximum limits. While a partnership firm caps the number of partners it can have to 20, there is absolutely no such limit in an LLP. Number 3. Internal management and decision making. Another beneficial feature of an LLP is related to the way its key managerial decisions are made. The partners of the LLP from among themselves select designated partners and assign them the responsibility to control the management. These designated partners offer their services for which they earn a certain amount of remuneration as decided by all the other partners and mentioned in the LLP agreement. While in a traditional partnership, any partner can make a decision and there is no need for him to consult other partners. Such decisions made by a partner are binding on all the other partners, even if the other partners are unaware of the decisions. Number 4. Liability of the partners. We will now discuss the most important point of difference between an LLP and a firm. Probably also the primary reason for the introduction of the very concept of LLP in India. It is the liability of the partners towards their businesses. Liabilities are the amount that a business owes to third parties and which eventually must be paid off by its owners. For an LLP, the liabilities that are needed to be paid are shared between all its partners in a predetermined fixed ratio, mutually agreed by all the partners and mentioned in the LLP agreement. Under no circumstances will any partner be liable to pay an amount that exceeds this ratio and beyond the capital that they have agreed to contribute. Now, compare this to a partnership firm. Here, the liabilities are usually shared among the partners in a certain ratio, but under extraordinary circumstances. Like in the absence of one or more partners, the remaining partners will be liable to pay off the entire amount, even exceeding their share as mentioned in the partnership agreement. Moving ahead, an LLP and a partnership firm also differ in the requirements of audits and legal compliances that they have to face. Number 5, audit. For an LLP whose turnover exceeds rupees 40 lakhs or capital contribution exceeds rupees 25 lakhs in any financial year, its account books must be audited for that particular financial year only. Whereas, there is no provision for statutory audit in traditional partnership firms. The income tax audit, however, applies in a similar way to both of them. Number 6, compliances. As far as their compliances are concerned, both LLP and partnership firms have extremely low compliance requirements. While an LLP just has to file its income tax returns, annual returns, financial statements, and the statement of solvency annually, a partnership firm eliminates the need of filing annual returns and merely files its income tax returns annually. So, as far as comparison on the basis of compliances are concerned, a partnership firm fares better than an LLP. This is it for this video. If you are interested to know more about this, you can check our website. The links are in the description box. You can also reach us by calling us at 9899-600-605 or via WhatsApp. You can find the link in the description box. And if you found this video helpful, please don't forget to like it, share it, and you can leave your comments down below. Also, don't forget to turn the notification bell on so you get notified every time we post a new video. Thanks for watching and check out our other videos as well.